working from home and such. So can you all see my screen okay?
Yep.
Yep, great, awesome. Well, so what I want to walk you through today is some startup models and methods, and I'm just going to walk you through some key metrics. So, and the 14 revenue models in particular, and kind of how I got to them, and some information about me. But I'll close with that information too, and I'll make these slides available to all the attendees, so you'll have a copy of them to go forward. So, from a about me perspective, five-time founder. I've been a venture capitalist for both Mitsui and Company out of Cupertino in Silicon Valley for about 3 years as a corporate fund, and then also worked with Seven Peaks Ventures for a couple of years as well. So, but I think of myself as a founder first. Did 5 of my own startups, exited 3, closed 2, raised about 12 million in venture and exited about 85. So no unicorns by any means, but not so bad either. I had a chance after working with Startup Next, after doing my last startup, to work with a program called Up Global, which was the merger of Startup America and Startup Weekend. And during that, we sold that company to Techstars. And so if you're not on mute, please put yourself there. We sold that company to Techstars in 2015, but my last full year there, we did 1,265 events worldwide with 74,000 attendees in 120 countries. So if you never went to a startup weekend, it's kind of a pickup basketball game for startups. So people would come in on Friday night and people would pitch their ideas, and there may be 30 or 35 ideas that get pitched, and it ends up being 8 to 12 teams that would kind of fall out of that. And people would join other people's teams, and by Sunday night, you would launch a demo in front of a group of investors. So we had just this amazing group of people who had started a movement that I got to join in process. I don't take credit for the movement by any means, but the team that I got to join was amazing at doing that. I'm shipping my first book. It's coming out in March. It's actually, I was telling you, Jen, before you all jumped on, it actually made Amazon yesterday, and it's called Trajectory Startup. And the idea there is ideation to product market fit. And the first sprint for a founder is, if you're doing a product company, is how do I get a product market fit? And that's actually on Amazon now. And I've done 10 transactions, so 8 on the sell side and 2 on the buy side. And then do that with Mark Upson at Next Path Advisors. So, and some of this content is program content that I make available to founders through the Trajectory program, which is a pre-accelerator program, which now is all virtual, which is great. So business model breakdown. First, I want to just give you the components of how to think about it as either an angel investor looking at a deal, or as a startup founder talking to angel investors, and how do you break down the model. There's 3 components within a business model, and a lot of people will be like, oh, that's in my business model, not knowing that there's a lot of pieces in the business model. Then the first piece of it is, how do you create value? And that's your product or your service. No big surprise there. If you're doing a service, you don't have to worry about product market fit because other people are doing that service. But if you're doing a product, that's why you have a sprint to product market fit, is the people care about the product that you're selling or not. So the first piece is of the Venn diagram here is the product or the service, and that's how you create value. The second piece is how you capture that value. We as investors look at that as the reasonable to exceptional profit that is associated with the sale process. So that's kind of the outcome. So I created a product, it has 65% or 85% gross margins, depending on if it's software, or 50% gross margin if it's services. So that's the outcome of that. And then the last piece is, how do you deliver value? And this is the one that's fairly complex, and the one I'm going to break down for you today in the revenue models, which is, how do I price it? What are the economics of it? What's my revenue model? And what are my sales and marketing activities? And what are the costs associated with those sales and marketing activities that either allow me to do it at a profitable outcome or an upside down outcome? So from an investor perspective, you can look at these key metrics at every startup you look at and go, I'm going to apply these key metrics to this particular startup. So the Venn in combination then says, I need all these 3 pieces. If my cost of sale, for example, is unreasonably high, and because I can't get my price up as well, then it's going to adversely affect my margins. If my product is super sticky, but my cost of customer acquisition is high, I need my lifetime value to be super long. So again, these are just sliders you're moving around in the value proposition stage. And at the earliest stage, at the early stage of revenue, they really are, what's your point of view, and do you think you can get there? If you happen to catch Zoom's big breakout yesterday and heard any of the conference call, one of the things that the CEO was talking about, that they have very few customers they charge $100,000 a year or more to. So if you think about that in context of DocuSign, which was an early AOA investment, you know, they had a price point for a realtor, but they also had $1 million price point for a bank. And the number of how you can upgrade that sales into a bigger price point was one of the questions about the total market opportunity as a pricing scenario. So that's kind of the price piece. The next piece is really how do you categorize your company? So as a founder, I tend to like B2B product companies versus B2B services companies. So as an example, a service company would be a consulting company, but a B2B product company would be something like Salesforce. On a B2C side, it could be a game company you know, the folks at Candy Crush created games, or it could be a for-profit school. I used to run Code Fellows here in Seattle as the CEO, and that's a business to consumer services company. But all of us as investors tend to gravitate towards the things we know the best. So for me, it tends to be B2B and definitely like product. I know B2B services, but it's not an investment area I would invest in because services companies don't scale at the core of it. So think about that as a category, because part of what we did with this data was we broke up a group of companies and started following them over a 5-year span. So how do you monetize a startup? And what we did with this one, and again, if you're not on mute, please put yourself on.
I don't know. Maybe I can say that my quiz.
Especially if you have a little person in the house. All right, so the data. So one of the things that happened with how I got to this data set was about 6 years ago, I was running a program in town called Founder Institute. I was a mentor at Techstars, and somebody came to me and said, hey, can I have your financial model? And I was like, well, you can, but mine's a subscription and yours is a marketplace, and those are different. And it raised the question of, well, how many models are there? Like if you wanted to do a template and provide a template for startup founders, how many templates would you need to do to cover the bulk of the market? So I'd gone to work at Startup Weekend and Up Global, and I reached out to Crunchbase and said, hey, can you just run a list for me, it was before their API, of every seed funded company in the last 18 months, total guess. It ends up being 2,654 companies, which now we've tracked using their API over a 5-year span. And I actually hired a team in India to help me go through and analyze what revenue model the company was. So we looked, the surprises in the data set was the seed rounds ranged from seed 1 to seed 10. So seed is a very broad category these days that tend to be milestone driven, where when I raised my first money in 98, that would have been a series J, right? Versus a series seed. The next big surprise was combination revenue models, and we'll talk about this one in a minute, was the fastest to mature, which is totally different than we hear from the venture community, which is pick one revenue model, it's subscription and stick with it. That's actually not the case. And the data was quite telling for that one. And then we went back and looked at the failures of the 2650. There was about 80 some, again, keep in mind, they had all raised at least a seed round of funding. So, so we went back and looked at the failures, and one of the consistent themes is that 80% of those who failed lacked a clear call to action, a clear product price point, and a clear pricing page. So we went back on the Wayback Machine and looked at their last cached pages to assess what do they have in common. And about 80%, a little greater than 80%, were super consistent along that. All right, so somebody said, look at the bottom left of your screen and hit the mute button if you can't see it. I don't think I can mute it. Let me see if I can do it real quick. Ejin, if you're still there, I'll have you mute him. All right, so that's the data in the data set. So what did we learn? So what you'll see is along the bottom axis here is the time to fundraise in days from seed to A, and on the left-hand side from A funding to B funding. And like you would expect, some of the things are exactly, so like transaction fee and rental business, or like to sell big data and to do commerce, it takes a long time to mature. What you see down here is gaming was relatively short on seed to A and super fast on A to B. Now the combination data wasn't a big data set, so we had to go back and clean this up, and we're refreshing it for the book. But overall, it's 4 to 5 times faster. So let me give you combination by definition is, think Smartsheet in Bellevue. They have a subscription-based business that does roughly 25 to 28% of their total revenue is services business. But that services business helps them decrease their sales cycle to increase their revenue and subscription. So as a public company, this data is public. And what Mark would tell you is that by having professional services as part of their product line with gross margins in the 50% range, that they're able to compress their sales cycle and make it faster for them to sell their subscription service. So the combination models could be a transaction fee plus a subscription, or it could be service plus a transaction fee, or services plus a subscription business, or metered service as an example. So we plotted that out using Mathematica, and those were kind of the big surprises. So from a business and revenue model perspective, I gave you the business model pieces. I'm just going to break down the revenue model components of it today, because the big takeaway if you're a startup founder is you just need to pick a primary and a secondary model. Your idea hopefully is unique, and the company you're building is hopefully unique. How you monetize it is not unique. Like, just pick one. Actually, pick a primary and pick a secondary. If you're an investor and you're looking at this data for the first time, so yes, the axes are in days. Somebody asked on the chat window. If you're an investor and you're looking at this one of the things you can help the founder with is like, how are you going to monetize this? Right? Just pick one, pick two. You can be wrong and pivot away from it. What you're not doing is you're not creating a new revenue model. You're having a point of view on the revenue model. That's what you're after. So all of these, by the way, lean towards tech versus like retail or things like that. That's really all I know. So does it apply to other businesses? Maybe, but I don't really have any data on that. I really apply it to tech. All right, so I'm just going to run you through the models relatively quickly. I have a summary one at the end, but I'm going to touch on sales and marketing at the end as well if we have a little bit of time, but you'll get the entire deck. So no big surprise, fee for service is the first one. It has to do with consulting services as an example. If you're in the restaurant business, it's the staff. It works in both business to business and business to consumer. The key metrics are your project revenue, and that could be if it's a project or if it's an hourly. Your cost of delivering, which is usually time, and your gross margin. So think of this as bill rate and pay rate. So if I'm paying somebody $50 an hour and I'm billing them at $100 an hour, I have a 50% gross margin in that business. That's my line of business, and my model is fee for service. As all of you know, services businesses are great businesses. They're easier to bootstrap. The challenge is they don't fundamentally scale, because every time you get a new customer, you have to get new people. And sometimes you need 3 new customers to justify a new person. So what you'll find in the small business dilemma is, boy, if we take on 1 new customer, we really need 3 new customers because we have to go hire another person to fulfill that role if I'm a 4-man, 4-person shop. So services are the easiest one to get. Again, bill rates and pay rates are the metrics you need to look at, and what are the gross margins. The heuristic there should be 35 to 50% or greater. If your margins are below 35%, you have a problem. If your margins are 35 to 50, you're probably in the heuristic range, but that's where they should be. Commerce is the next example. Amazon's an easy example. It's both B2B and B2C. It's typically where I'm selling somebody else's or my own product, but they're selling a product, not a service. So something who can be skewed up as a product with an SKU. My key metrics here: what's my wholesale cost of goods sold? What's my average margin percentage? And what's my average basket size? Because then I can start to calculate out what my lifetime value is going to be over that time as I grow those number of customers on a monthly basis. They can be physical goods, they can be wholesale costs, they can be virtual goods, but commerce is one of the easiest ones to get because it's just commerce, right? So I'm selling a physical or virtual product, and I have gross margins and average basket. In Amazon's case, commerce matured into a marketplace where they started selling other people's products as well, but we'll talk about marketplace in a minute. Subscription's super exciting these days. Most people like to go to the subscription business. If you've been around Seattle a long time, you know 15 or 20 years ago, there was lots of hand wringing from Microsoft about, oh my God, can we go from licensing to subscription? And everybody was, like super freaked about it if you go back and read the articles. Subscription's a great business. The reason subscription is such a great business is because it has the highest multiple on enterprise value at exit. So having helped companies sell, and that's where I make most of my money today, is subscription businesses are the ones you like because it's predictable ARR, annual recurring revenue, and MRR, monthly recurring revenue. And is it growing, or is it flattening, or falling off? Your key metrics here are average revenue per user, ARPU, conversion ratio, for example, trial convert to paid is one of your key metrics, and churn, which is how many people are leaving you on an annual basis, or could be down to a monthly basis. The inverse of churn, by the way, is net negative churn, which is if I'm increasing my product quality and my annual contract value is going up. So I took somebody from a $10,000 annual contract value to a $40,000 annual contract value. You'll view that as a net negative churn, obviously a huge positive impact on the business because your cost of customer acquisition goes down and your lifetime value goes up, but it doesn't just go up, it goes up with annual increase in lifetime value. So that's one of the early features to look for in the subscription business. The challenge with most early subscription businesses is you have lots of early churn because your product's not really great. It's kind of an MVP, but know that as the product improves, your churn should go down. All right, metered service. In the 6-year span, we've been looking at revenue models. Metered service is one of really the only new one. I had coins and tokens on here originally and ultimately took them off because there are no metrics that go with coins and tokens and ICOs. If you don't have a metric, it's not a revenue model. Metered service examples, there's Azure would be an example, or AWS, or Splunk, or Twilio, which is as my usage goes up, my price goes up, but I don't mind it because it means I'm making more revenue. So in the case of Twilio, my number of text messages go up. It doesn't feel punitive. It feels like my business is growing. So metered service is one of the new ones over that 6-year span, but probably the only new one. This one, I've only found B2B examples. I've never found a B2C. If you have one, please share it with me. I'd be totally happy to add this one. Your key metrics here are your average revenue per user, again, ARPU, your conversion ratio, which is, again, trial to purchase, and churn. And then within that metric, you're looking at usage statistics on a monthly basis. Is usage going up or is usage going down by customer segment? But again, all B2B, no B2C on this one. If you have a B2C example, let me know. All right. Transaction fee or rental business, think of Chug. If you have kids in the college age, they're renting a textbook instead of buying a textbook. Think of Kickstarter or Elance, where I'm taking a transaction fee off the total value. What's unique about transaction fee is I'm not booking the top line revenue. I'm only booking the realized revenue. So the realized revenue is just my transaction fee. The key metrics here are average transaction revenue, percent of the transaction fee, and the number of transactions per month. So if you think of this as what company, Upwork is the company. When Odesk and Elance merged to form Upwork, they had to increase their transaction fee percentage because they had dropped below about 15%, and the CEO made a big deal about getting it back up to 20%. So if you see a transaction fee business and they're starting their pricing too low at 5 or 10%, they probably don't have enough margin to make it work. They're probably going to need to be the heuristic. Again, it's just a heuristic. It's probably in the 15 to 20% range. All right. So just transaction fee. Productize a service is a unique one. I've been on the board of a company in Bellevue for 15, 16 years called Guidant Financial. Guidant allows you to take your 401k and create a self-directed IRA. So for example, I can invest in a franchise or I can buy a business, but I don't have to pay the penalties and taxes associated with moving my 401k over. Now, there's services behind it. There's people who are doing that work, but you as the customer doesn't care. You're just buying a SKU and the outcome. And then the business there is using all the tools and tech to automate customer acquisition and also tools and tech in the back end to lower their cost of delivery as they face downward price pressure. So that's Productize a service. There's still people involved, but the idea of Productize a service is it's scalable as the business grows, and you can keep your margins high rather than just throwing more people at it. It's in the consulting business, you'll see junior associates and senior associates, because in the senior associates, you can't get their margins up. So you have to bring on junior associates to get higher margins in that service side of the business. So that's Productize a service. That's number 6. Combinations I mentioned, which is just services plus subscription or subscription plus transaction fees. And the heuristics there are the same of each of those models, but know that combinations are number 7. All right, next one's marketplace. Think eBay and Alibaba. Marketplaces are tough. I've had people say, Dave hates marketplaces. I don't hate marketplaces. They're just hard because I need to do cost of customer acquisition on the sell side and cost of customer acquisition on the buy side, and I have to ratchet them up. So early marketplaces, the winner in an early marketplace is the seller. At maturity, you have equilibrium. But in the early stages, you have to have product to sell. Otherwise, you're doing marketing spend on cost to acquire customers on the buy side, and there's no product there to buy. And you just can't spend that money on it. So keep in mind, there's two funnels associated with marketplace: seller funnel, buyer funnel, and then the transaction value. If you do it well, you've built an intrinsic moat. But you have to do that marketing very separately, and you have to track it very separately. If you merge those two data sets together, there'll be no way to get a really crisp view of cost of customer acquisition. And you really need to do that from a marketing spend perspective. So it works B2B and B2C, your average transaction amount, number of transactions a month, and what your commission spend is. All right. Lead generation, some of you know All-Star Directories here locally in Seattle. The lead generation business is one that you probably won't invest in. It bootstraps very well, but it's freakishly competitive. Like the number of competitors that All-Star Directories brought into the market, and it basically follows the downward curve of Google AdWords spend. So if you think of mesothelioma as the highest words, and mortgage insurance and auto insurance and life insurance, and you take that Google spend on keywords, you can follow the lead gen path down market. But it's a legitimate business model. So if you, for example, can create leads cheaper than a life insurance company can, you can sell those leads online at margin. And that's exactly what the lead gen business model is. So again, not one that will be focused on an investment because it bootstraps really well, but one from a founder perspective, you can look at it and go, can I create that? By the way, these get progressively harder to do at launch and easier to do at scale as we get to the last few. So for example, when we get into gaming, gaming has shifted from pay to download to in-app sales. Gaming is all about fun, right? Your key metric is really, do I have a fun product or not? Is it a good distraction, right? 02 was Dave Bloom started that company within Madrona Venture Labs before it was Madrona Venture Labs. And the idea was, we're not solving a problem, we're just creating distractions for people and it's fun. But your key metric starts with, is it fun and is it sticky? So I have my number of downloads. By the way, this one's only B2C. Number of downloads, the percentage people who play it, and the average in-app purchases in a given month. One of your key metrics, by the way, on gaming is 21-day usage patterns, because it's a very hit-driven business model, like movies, right? So I can't rest on one hit. And I think 02 sold to King and Candy Crush, by the way, as well. So gaming is one that's B2C only. All right, here's some that only work at scale, and we'll finish out on the 14. Licensing and search, it's a legitimate revenue model. However, it doesn't work at launch. It only works at scale. If you have less than 1 million uniques per month, you can tell me as an investor that you're going to do advertising and search, and my question will be, that's great, and how are you going to survive until you get to the volume you need to make any money at it? So just know that that's key. So is it a legit model? Of course it is. It works for Facebook, it works for Google, right? But you need to have volume first. Works B2B, right? It used to be hard to explain, hey, if the product is free for you, you're the product, right? So you're the user in Facebook case, but the business, it's their B2B advertising is their business model, their revenue model. You as the user get it for free. And if you get something for free, you're generally the product. 2 years ago, that was hard to explain. Now it's not. So that's advertising and search. New media is the buzzy one that people get super excited about because it has, when people say, I want to go viral, this is exactly what they mean. That's new media. New media is classmates, early days, Snapchat, WhatsApp, Pinterest, a company that has, think of word of mouth as the basic, network effect is the next step up, and viral coefficient is the top tier. So word of mouth I can get as a business, but I'm not going to get much of a network effect. I can get a network effect, but I'm not going to get a viral coefficient of greater than 2. So new media is where the network effect builds on itself. And for every paid customer that I acquire greater than 2 through the referral process that actually convert to use. Not they just convert to download or convert to trial. So the viral coefficient to go viral is greater than 2. So it's typically only B2C. There is one window where LinkedIn created the tool that allowed you to upload your contact list, that their referral factor got higher than 2, but then it filtered back off. And if you follow Tomas Tongas from Redpoint Ventures, he's written about some of that viral coefficient. Actually, I dropped one of those graphics into the book because it was so well done. It was like, I don't want to do that research for sure. So B2C only, K factor is your viral coefficient. If it's greater than 2, it's amazing. Unicorns, butterflies, incredible. But when somebody says, we're going to do this and then we're going to go viral, this is what they mean. You can plan for it, but if you get to do it, it's magical. I think I've worked with 2 companies in my career that went viral, just 2. They were both great, by the way. Classmates sold for 157 million in cash. So that one's hard, doesn't work B2B. Big data is another one that works at scale. If you don't have the data, you can't sell it. At scale, you can sell it, but you have to go get the data first. So Patients Like Me is a great example. They anonymize all the data, sell it back to pharma companies to be able to say, oh, we want to try this. How big is this market sector? So legit business model, but just doesn't work at launch. And then 14 is licensing. So some of you remember Microsoft licensing. My first startup was in that category, the licensing space. And licensing still is a legit model, but it's one that's definitely been in decline over the last few years as everybody's moved to subscription. And again, people move to subscription because you're multiple on revenues and recurring revenue relative to the enterprise value of the company is the most important. So those are your 14 revenue models. And again, I think if you're a founder, pick a primary and a secondary. If it's subscription, great. If it's transaction fee, great, right? But pick a primary and a secondary. And should you use services or not use services? I don't know. If services help you compress your sales cycle and sell the product faster, the answer is rock on, like totally use it. If you're an investor and you're looking at somebody who is doing services today or non-recurring engineering expenses to build out their product, I think that's a good thing from a scrappiness perspective. Do you want them to get to a pure monthly recurring revenue subscription business? Maybe they always have services like Smartsheet. I mean, Smartsheet went public, they're doing just fine. So, so yeah, those are the 14 revenue models. I've got about 5 more minutes and I'm going to walk you through just how to think about sales and marketing as an investor. And as a founder, the context here is I want to create an opportunity for what I'm looking for as an investor when I look at your metrics. And so I'm going to walk you through a sales funnel and some basics on a marketing funnel and some basic on sales. So finding customers is all about your value proposition and your marketing spend. If your value proposition is wrong, all of your marketing spend will be off, like no question. So you really need to do the customer development and know that the value proposition lands on your ideal customer profile. So the slide that I always take out to Techstars when I do the very first week of information is you're going to ask me for a check in 90 days. Here's what I want to know in 90 days. You may have 0 marketing spend now, but these are your key metrics that I want to track. So at the top of the funnel, I have, here are my channels. And these are just some examples. It could be organic search and SEO, could be paid search, could be word of mouth, could be sales calls, email, PR. You'll see my last one here is miracles. That's the one that says, I don't have a plan of how I'm going to spend $1,000 this month on marketing. It's not acceptable. Like, just because you built a better product, nobody cares. Like, you need to get marketing spend out there to do this. Do you know what your marketing spend should be today? No, but in 90 days, you should have some data that goes with this. So if I was to spend $1,000 today, how would I spend it? Well, I'd buy a list and I do outbound sales calls. Great, that's a channel. So $1,000 spent, how many marketing qualified leads, B2B here for a second, I'll compress this to B2C in a second. B2B says, how many people came to your site from which of these channels and filled out a form that said, my name's Dave, I want a demo. That's a marketing qualified lead by the simplest definition. Then somebody has to pick up the phone and call Dave and say, hey, I see you filled out information on our site. Can we give you a demo? Can we schedule it? Right? You're gonna use a calendar tool like Calendly or something like that to get it scheduled so you don't have that extra step. So marketing qualified lead is form data. Sales qualified lead is, I've talked to Dave. I did a demo for Dave. So what I wanna know on that $1,000 spend, how many people visited your site? How many people became marketing qualified leads? How many sales qualified leads did you get? And if you're fortunate enough to close them in that same 30-day window, how many customers did you get? And then you'll see to the left there, what's my time to close? So, and originally in the first 30 days, it's going to be rough. Like the answer is, I don't know. And I don't know where they're coming from. And we don't have lead attribution set up and we don't have Google Tag Manager set up. All those things are things that you can do, right? So you don't have to freak out about it. But what I want to get at the top of those is what's my marketing spend on a monthly basis? How much are you spending? In which channels? Create how many leads? And then a month by month basis, what percentage go from marketing qualified to sales qualified? What percentage go from sales qualified to close? Is it 97 days to close? Is it 37 days to close? And what's the trend data around that closing ratio? That's the basics math on the marketing side. Now, if you're B2C, we're going to take MQL and SQL and we're going to combine them because it's probably going to be transactional. Your price point is going to be low enough that somebody can put in a credit card, buy today, totally fine. So MQLs, SQLs are going to be combined into just leads. So I have traffic, now I have leads, now I have customers, I still have time to close, and I still have marketing spend. From a tactical perspective, if you're a founder, you don't want to spend all $1,000 this month on one channel. You have to always be testing. What you will find is some channels will be more profitable than others, but they're still good channels. So you don't want to be one channel only. You want to be multi-channel in what you're testing. So that's kind of your marketing breakdown and marketing funnel breakdown. If you're an investor and you like the company and you like the team and you like the market, I would challenge them, and I'll make sure this graphic's available for you. I would challenge them to say, hey, over the next 3 months, go do this. Like, I want to just see how these things come together. Let me give you the multiplying effect as an investor. If I see their lead volume at the top of the funnel and traffic is going up, woohoo, right? If I see the number of qualifying leads are going up, that's great too. If I see my conversion ratio is improving, that's awesome. If I see my average revenue per user is going up, and if I see my time to close is going down, you're sitting on the brink of product market fit, and the founder just probably doesn't know it yet, right? They feel good about it, right? But feeling good about it and having the data is the two different things. But if you can sit down and look at the founder's data, see the lead volume is increasing, the time to close is going down, and my average contract value is going up, it's a good time to invest, right? Because they have a little bit of data. Help them get to the data, which will help improve your visibility to how do I feel about this one based on data, not just how do I feel about it based on feelings, okay? All right, last thing I want to just hit on, and by the way, I broke this down in the slides, so you'll see more slides. I just want to mention sales and how do you capture that? So there's only 4 ways to sell today that I know of. And by the way, this slide hasn't changed in like forever. There's web direct sales, which is I can go to your website, I can transact, I don't have to talk to anybody. There's direct sales, which can be outbound sales or inbound sales, but somebody has to talk to me to make the sale. There's indirect or channel sales. So Microsoft was great at that, but you have to have the channel to make it work because channel sales only work if they can fulfill the demand the company creates. If the channel is expected to create demand, it just doesn't work. Channels aren't good at that. And then you have retail, which honestly, I don't know anything about. So, but it's still there. It's a legitimate channel. Think of that as distribution. Who else could sell my product and what's the 2-tier distribution channel for me to do that? So here's your sales hypothesis where it works. Web direct, if it's a known market, if I'm selling a product category that people know, I can do web direct as long as the price point is low. Like, would you buy a $10,000 cruise reservation? Well, forget during COVID anyway. Would you buy a $10,000 cruise reservation without talking to somebody? And the answer is probably no, right? So if it's high price point, I have to talk to somebody. That's direct sales. If it's a known market, talk to somebody. If you're creating a new product in a new market that no one's ever done before, your choice is direct sales because no one's out searching for those keywords on Google. So you have to create an ideal customer profile and then actually go pitch them on your idea, but nobody's out searching for it. Indirect works for known markets, low price point, and known search words. So again, if you're going back to your marketing spend, if I want to look at keyword spend, it only works if it's a known market. If it's a new product category, it just isn't going to work with search engine optimization or paid search because no one's looking for it. It may work with ideal customer profile and banner ads and ad search for things like Facebook, as long as the price point is low enough. So this just tells you at some point, somebody has to sell something. I'm glad you built a product. I'm glad it's amazing, but you're going to be the salesperson. One other last quick note before I transition to Q&A is if you look at the bulk of the zombie startups that are in market today, I would tell you most of them have never scaled past the CEO salesperson. At least so zombies are the worst possible option, by the way. So it's not a path to exit. It's not a path to the next round of funding. You've taken money from other outside investors, so you feel guilty and you can't close it down, right? But zombie startups are the worst possible option. Like if you go fail, you tried hard, and we know as investors you tried hard. But if you're still working on the same company 8 years from now and the revenues are still flat, and there's a reason you can't raise funding, that's the reason. So that's the quick overview on revenue models and sales. So revenue models, sales models, marketing methods. Marketing has lots of methods, by the way, and it's a wildly creative topic. And then pricing, you'll see at the end of the deck, there's a little bit on pricing at the end. It's just in the slides. That's a whole nother seminar on how to do pricing. But I wanted to give you an overview of revenue models and a little bit of a overview for the book. So what questions do y'all have? Yeah, you're like, I've blown through a ton of topics. I'm gonna go back to the revenue model, so in case there's questions about that. You have to take yourself off mute or ask him in the chat window.
I'll go ahead and ask one. Thank you, Dave, for this. This is really helpful. We're a software as a service, B2B to C company, but we do wrap in one of our products actual data science services in our research product built by researchers for researchers. Mm-hmm. Would that be considered a secondary revenue model because it's still part of the overall annual subscription?
Yeah, so if the price is included in your subscription, then it's just a feature within your subscription. If you charge for it separately, or you give it away as a loss leader to do customer acquisition. So for example, you bundle it in with if you buy this, we get that, and if you think about it as I'll pull up a level, Will, think about it as an on-ramp product opportunity. Like how can I take friction out of do risk reversal for the customer so that the customer has less risk in buying my product? So maybe that's a way that they can start to engage with you, and you charge them for that, but you give them the first month of the service subscription for free. Again, marketing methods here are different than pricing models, but think about it, how do I take friction out of it? If it's bundled in the offering, it's just part of the offering.
Right, and we've done that in order to essentially justify the price point, because it's far easier for our data scientists to work with our data and extract features than for them to hire a data scientist for the research project.
Totally. Yeah, totally.
Great. Thank you.
Yeah, of course. Other questions? I have so geeked out on these data sets for so long, you guys. It's like it's fun for me to get to be nerdy with you, but some of you are like, oh my God, he knows way too much about revenue models. That's true.
Hey Dave, it's Mark Alexander.
Hey Mark.
How are you?
Good, thanks.
Been a few years.
Indeed.
Hey, so I wanted to ask what the best way is to showcase the variables in the revenue model. You know, we're definitely a B2B, but because we have a physical product, something that people actually buy, mm-hmm. along with subscription and I'll call it cloud-based data services, we've got multiple dials to turn. And in some investors' case, they kind of like the dials because you can low price your physical product, and you can sort of change the subscription or the transaction model.
Right.
Because there are so many variables, and because we can apply them to certain industries, sometimes that confuses investors. So what is the best way to approach that challenge?
Yeah, so I always kind of think about these and back into them. This is a good question for the investors. I back into this as the way to think about it is how is it going to look on an Excel spreadsheet, right? And the way this is going to look on an Excel spreadsheet is you're going to have one page of assumptions, and you're going to have, in your case, 3 products, right? Product 1, product 2, and product 3. Product 1 is your subscription business. Product 2 is your, right? So you're just going to break them down. And then what you're going to see over time is a blend of product mix, right? So this product is, it's going to go up in revenue over time, but it's going up slower than the subscription product. Or this service revenue stays about the same from a gross margin perspective, but it goes up as overall customer volume goes up, right? So what you're tracking there is product mix and blend of revenue.
Got it.
Then the other thing I would come back to, Mark, is I think about it in the workflow of the customer, in which product comes first, because in essence, what that becomes for you is your cohort analysis, right? We know that customers buy this, go on and buy these other things, but this is their lead product. So what you want to kind of blend together is which product starts, right? And now I have a yard guy show up, so I'm going to close my window.
No worries.
Hi, Mark. Gabe here. Quick question about investment ask and kind of getting into like what are some shortcomings for when people are actually going and doing their investment pitch and asking for particular prices. I was curious if you had any ideas or comments on like common shortcomings of like, let's say I was asking for $100,000 and then the group only wanted to give us $50,000 and why people end up getting that kind of a different price actually offered to them than what they're initially asking for, or just challenges that you see when people are trying to come up with their investment ask valuation.
So the way I would encourage you to think about it is, what do you need for the next 18 months? And what are the milestones that you'll achieve in that 18-month window? So that should drive the overall fundraising cash number. So usually if you're asking for 100, it tends to be a round number that you're asking for. Investors will come back at 50 because they're like, we think you can get further with this than you probably think you can do. And some common mistakes there are, well, we want 2 years of time. And time doesn't really matter to us. Milestones matter to us as both the founder as investor. Like, what milestones am I going to hit with that revenue? So each round of funding is going to roughly require you to give up 25 to 33% of the company. So the math on that from the last Crunchbase data I saw was 28% was the average round. So you're going to give up a certain percentage with each round of funding. And that percentage is going to be should equate to your 18-month window.
Awesome. So, and to follow up on that, kind of a second question there would be like kind of looking into like breaking down expenses like marketing, like you were talking about, like, okay, you should definitely be like trying out a few different like venues or methods of connecting with your customers. So is it like, if you're trying to figure out a way to like kind of itemize your marketing spend or different things of that nature, what are some typical challenges that you see with investors that startups and entrepreneurs have with actually creating like value for like how much that marketing spend would be?
Yeah, so I mean, the biggest early challenge is lead attribution. So it's getting the people who visited my website to have some sort of lead attribution, which is typically Google Tag Manager or Google Attribution Manager, right? So that I can track where that source came from. So it's easy if you're like, we did a trade show when we got 112 leads, right? And those leads took this amount until COVID happens, and then there's no trade shows, right? So now you need to take your marketing spend and spend it on other channels. So what happens is ultimately you'll start doing cohort analysis, Gabe, when you have more data. But early on, it's more about having a thesis and a point of view about, okay, I'm going to spend $350 on this channel, $350 on $350 on AdWords, $350 on Facebook ads, and $350 on list acquisition and sales calls, right? Or email marketing.
Yeah.
Then I'm going to track each of those to distinct landing pages. Sorry for everybody, this is super tactical. I'm going to track to different landing pages. I'm going to track my conversion rates at those landing pages. And it's basically kind of marketing 101. It's just going to go into a Google Sheet. But every month you do it, you're going to have a perspective on like, oh, this channel worked, but it wasn't great, but we'll keep spending on it because it created customers for us. Ultimately, the thing you want to track to, and where most customers, when you start to have this data, most investors get excited. I can tell you that my lifetime value to CAC ratio on a B2B company should be greater than 5 as the heuristic. And on B2C, it should be greater than 10, which means if I spend $10 to acquire a B2C customer, that lifetime value should be $100. In the early stage, you can't calculate lifetime value greater than 12 months because you have no data. But once you have the data, you can extend that lifetime value up to a time frame that actually works. So if I have 18 months worth of data, I can have an 18-month lifetime value. So when you have the start of that LTV to CAC ratio, and I can track it from a month-to-month basis, and again, you may find a distinct measurement for your particular business. These ones are all prescriptive that says, even if you find the distinct unique one for you, at least start with these because they're better than none. And most early stage startups at the AOA investment stage don't have much data. And I'm just trying to get you to get some data because that'll help.
Definitely. Thank you so much for that. Appreciate your response.
Oh, you bet. You got time for a couple others.
Hey, Dave, that was a great breakdown on the revenue models. did you capture any data? Can you share anything about actual pricing challenges? Like what would be the good pricing levels for these various revenue models? Anything to share on that?
It's pretty broad. So when I started off doing the book, we did a 6-month startup, is now called Trajectory series. When I started the first series and the first time we did it, there were 2 big questions that came up that I realized nobody has written much about. One was ideation, which is how do I start I want to be a startup founder, but I don't have an idea, right? And the second one is how do I do pricing? So the big aha with pricing was that most founders don't change their pricing in the first 3 years, tragic fail, and that most of us know all of the ugly warts on the product because we built it. So we tend to price it too low. So the big takeaway at a meta level, and changes with each revenue model, by the way, that's why I'm not going to go into detail. The big takeaway was to do a quarterly pricing committee where you look at the competition and you look at the market and you look at conversion rates in sales so that you can start to have a point of view. It doesn't mean you're going to change your pricing quarterly, but you should have a point of view on your pricing. So if you said, show me a picture of your son, I could show you a picture of Brandon when he was 2. He's 27 now. So it would be true. It just wouldn't be accurate. And pricing is the same way. So you need to look at it on a quarterly basis.
So is it true that most products are underpriced?
I would say from a founder perspective at the early stage, the answer is yes.
Okay. All right. Thanks.
You bet.
Hello.
Yeah.
Yeah, I'm working on a B2B product which can be marketed to freelancers and corporates both. So which should I start with marketing to first? And secondly, can I charge different prices from both the segments?
Give me a little more detail.
Yeah, it's basically a content marketing tool which I can use for freelancers also and for corporates also. Both can use. Which should I market to first? And secondly, can I charge different prices from both segments? Because corporate, I can charge higher prices and freelancers the lower prices.
Right. And B2B was probably, so a couple observations. One, over index on time to close. So you can test both, right? B2B and B2C, because the freelancers are going to act more like B2C in how they convert.
Yeah. Okay.
B, I have a company credit card, so it's more likely I'm going to convert faster would be my hypothesis. Test it, right? But I bet you a beer that your B2B sales process is going to be faster and less risk averse because I'm not spending Dave's personal Amex card. I'm spending my company Amex card, which means if you can save me some time as a product marketer, whoever your ideal customer profile is within the business, that I'm going to be reimbursing for my company rather than paying for myself. So I think that'll be a faster sales cycle for you is my guess, but it's heuristic data, not a depth of data.
Can I charge different prices for both the segments?
I would do pricing landing pages for all of them and send all of your traffic to A/B testing pages. You can use a product like Unbounce and send it to 2 different landing pages. Don't make pricing navigable from your main menu. Hide it for that week. Drive enough traffic to both A/B test it. So I'm a huge fan of A/B testing because I have opinions about everything and they're generally wrong.
Oh, okay. Thank you.
Yep.
Hey, Dave, this is Kanika. Quick question for you. Hey, so we have AI platform that extracts information from documents and web pages. So when I look at the different pricing model, the revenue models, we are a combination of subscription, metered service, and fee for service. The reason is because when the customer brings in the problem, we have to spend a couple of weeks time for getting them to use our product to build the right AI. But then once that's done, we get into the subscription mode, which goes, it's ARR. But then there's also metered service because we need to charge them based on how many documents or web pages they're processing.
Right.
Would you recommend breaking down the pricing models across these 3 segments or offering a fixed price?
No, I would. So this is, again, comes back down to how you model it on a spreadsheet. In your spreadsheet, so you're going to have product 1 is going to be services. And it's going to have bill rate and pay rate and how much we can charge for it and what our gross margins are, right? So that's product 1. Product 2 is going to be subscription services, which may even be tiered, right? And that may be the place that you start, right? You may say, we're not going to worry about metered service until we have enough data. So we're going to tier it based on broad buckets. So, which is probably the easiest option. And then as you have the data, you can go to a metered service, which is we're going to pay per use. But those end up being three different, so if you think about them as lines on your spreadsheet, you have three different product lines. You may introduce metered service in 9 months, and you're gonna have a price associated with that metered service in your hypothesis, right? Your pricing assumptions tab. But you're gonna have a price per metered service or for subscription. And to start, I would probably just tier the subscription services based on what your swag is on your guess.
Right, so you basically tier it on volume with some
you're implying the
estimation.
direction of, you can post that you have a metered service, but if you come on and sign, so one of the things I always encourage startups to do is price where you think the market is and then promo and discount for the first year, right? But if you start off with, when I hear a founder go like, oh, we're gonna be free forever, I'm like, you're dead. Like that just doesn't work, right? So you have to set value expectations, but you can discount for promo code for early adopters. Right? You may not grandfather them for life, but you want to set an expectation that like, oh, and by the way, it's going to be a metered service in the future, but you're in early, so we're going to waive the metered service for the first year, right? But set the expectation that pricing is going to be up.
A follow-up question on that, Dave. So, would you recommend the tiered services to be, to limit the features in the smaller tier and add more features in the bigger tier? We're looking at that, but at the same time, we're hesitating that if the customer doesn't see the value in a smaller tier, they would never really go to the next one.
Yeah, that's usually the case. When you launch as an MVP, you can't typically de-feature something and have it be super useful. So, and keep in mind from a marketing perspective, freemium is something that's typically B2C, and time-based trial is typically B2B. Because again, if on a B2B side, if you de-feature an MVP, the answer is I don't have a product to sell. So I would keep pushing the features out and tier the price. And then as you have a clear break where it's a different customer segment, and you'll see that in cohort analysis, where it's a clear break that the price goes up, then I would look at that and say, okay, that's a clear break. Prices are going to go up. That feature set gets us to a different customer.
Thanks, Dave.
You bet. All right, we've got just a couple minutes left. So if you want to contact me on Twitter, Get Trajectory is the website. I posted the link to the pre-order for the book. Have your expectations set, however, that it's not coming out till March, doesn't ship till March. Publishing is not fast, I have learned. But any other questions I can answer for? We'll take one or two more and we'll wrap up.
Hi, Dave. Thank you so much for the super invaluable presentation. As an early stage startup that's looking to possibly acquire funding, obviously the most important of the three topics that you covered is revenue and trajectory. Two questions. How important is it to cover sales and marketing? Sales less so important in my use case. And furthermore, how do you quantify marketing if it's more in the early stages going to be relationship based to acquire large swaths of customers?
Yeah, I mean, early days, your first, I think it was 10, 100, 1,000, right? My first 10 customers are force of will and hand-to-hand combat and based on relationships. But what I want to know as an investor is, can you scale past you, right? That's kind of the key question. And that's the zombie startup CEO salesperson question, right? Because you have other stuff you need to do too. So, but your first 10, 100 customers, definitely, right? It's going to be all about relationships. The question is, how do I scale? So think of it this way. Investing in early stage startup is risk capital. It's binary. It either works or it doesn't work. But investing in a growth stage company, because you're spending $1,000 a month and I have what's called ROAS, right? Return on advertising spend. Once I know what my ROAS number is, I'm spending $1,000 this month, and in 72 days, I will have $12,000 in return, right? Or in 30 days, I'll have $91 in return against $1,000 in spend. Like, I need to know that basic math because that's a scale question. And when you take it from a risk capital question as an investor, like, hey, I like this team, their idea is super cool, it may work or not, to like, oh, by the way, we spent $1,000 in sales, we're 67 days to have ROAS, return on advertising spend, and that lifetime value of that customer is this amount. Like, then as an investor, I'm like, ooh, this is super exciting. Like, what would you do with $10,000 a month in marketing spend? Right? So you've shifted the dialogue from will this work or not binary risk to how does it scale? Now, as an angel investor, the answer is I still invest in teams and super early and wildly early stage of like, this is a badass idea and an amazing team. But as you shift into institutional money, right, as a VC, I want to know that I've de-risked the investment because it can scale. And having data around your sales and marketing data shows me that you've de-risked that. And until you have that, going to venture capital is probably pointless. My perspective as a founder.
Got it. Thanks a lot.
Yeah, of course. Okay, last one. Ejin, back to you.
Great, thanks. Thank you. Thanks, Dave, for hosting this session. We really appreciate all the insights and the data analysis that you shared. We're always privileged to have a best-selling author, do a big presentation for us, right, before it becomes world famous. So thanks again for all the time. And I know there were many questions about like presentations, slides, and recordings. All these will be made available as long as you are signed up on the Eventbrite. All right. And so with that, I'd like to thank everyone for joining us today for this session, and wish everyone a great rest of the week. Thank you very much.
Thanks, everybody. Enjoy your weekend.